Hello and welcome to the Future of Day Trading Remastered for 2022. In this lesson, we'll be talking about trend architecture and arraying. Okay, let's work with some trends. Let's do everything from creating their architecture, their origin points, where they exist, how we use them, how many do we need on our charts. Let's just go through a full episode of dealing trends and trying to master these things. Okay, so the first rule when we're using trends is you're always going to be using accumulation to accumulation candles and never the bodies. So whether it's on the top side of your chart or the bottom side, we always use wicks of candles and not bodies. So we always want to use accumulation to an accumulation point on our charts. And this is how we get accuracy when we're dealing with trends. Now that goes for the top side. On the bottom side, you always want to be using distribution to distribution candles. Now, like I've told you in my previous videos, I have my charts as blue and beige instead of red and green. But if your charts were red and green as the normal default colors, it would be red on the bottom side and green on the top side. So if I were to zoom in here, you can see that the first part of building proper architecture with trends is just simply taking the base point, which is the very first trend point, and the reach point. So the base is the first point, the reach point is the second point, and making sure you're attaching them accumulation to accumulation on the top side. Or again, if it was the bottom side, you would simply go like this and attach distribution to distribution, right? Now, just so we're very clear here, I know there's a candle right here that comes up and it is a blue candle. So I actually can't use this candle. It isn't something that I would use as a trend prior to its existence, which is the effect of time. We'll talk about that in a future lesson. You would be using your replayer tool here, and I would simply cut my replayer tool back and I would go to the accumulation candle. I indeed wouldn't go to this distribution candle, even though it looks like it lines up. You are always only ever using accumulation to accumulation candles on the top sides of your chart. And then again, on the bottom side, the same thing. So if I were to simply mark distribution to distribution and accumulation to accumulation here, you would have an accurate representation of trends and you would have a higher level of accuracy associated with those trends. So I'm just going to hit play here and you can see that this trend held this back and it moved through that trend down to the bottom. So this is a very simple first rule. We use accumulation to accumulation candles. And in the future, we're going to learn how to adapt them to hard closes, and you'd array it out to here. And on the bottom side, you'd be using distribution to distribution candles, just like this guy right here, distribution to distribution on this side, accumulation to accumulation on this side, which would array to your next accumulation candle once it hard closes. Again, we're not going to be talking about hard closes in this lesson, but in another lesson, we'll be discussing hard closes and exactly how they affect our charts and how we can use them. In this lesson, we're simply putting out the rules of trends, building out the architecture of them, and starting to learn about how they work in our charts. So let's zoom out a little bit. Let's get our replayer tool to the current state and let's delete some of these trends so we can just start to see how we would first mark out trends on our chart. The first thing you want to do as a rule of the effect of time, which will be in the next lesson, but we can go through a little bit of it now, is to go to your highest time frame and work down. So we just go to the daily time frame and we can simply mark the accumulation candle here to here, which will give you an accurate representation of what your trend looks like. Again, we can't use distribution candles, so theoretically, you wouldn't be able to use these candles here. They would break the rules of charting, and they would break the laws and the sciences that actually control these charts. So if you were to go back in time to this moment, and you marked accumulation to accumulation, you would have an accurate trend going forward in the future. And let's see what happens. Aha, it hits your trend perfectly, and there you go. You have perfect accuracy because you used the correct rule to create your trend architecture. And that's really what this lesson is about. It's all about creating the correct architecture on your charts. And it's also about understanding how we array trends. So let's hit play here, see this chart go through and get to the end here. And let's use this same rule of distribution to distribution on the bottom side, and we can array it out to the furthest one here. Now, if we were to start moving down in time frames, you could see further points, or you could actually just use this starting point right here as the accumulation candle to your first accumulation candle here, which would give you your first breaking point. And what we're doing right now is we are creating an architecture behind our trends. So what that means is that we don't have just one trend. We have larger trends that encompass smaller trends that encompass smaller trends. And the larger the trend, the bigger the move. And the smaller the trend, the smaller the move. So this acts like chain lightning if you would think of it, where you have one trend that starts like this, it breaks off into another trend, that breaks off into an even further trend, and sometimes that breaks off even to a further trend. So the base point, which would be the first point that it gets created, has a reach point where you pin the candle to. So this would be your base point right here. And where we pin the candle to right here would be your reach point. And it would go like this. this would have then created the reach point as the new base point for your next trend or your trend moving forward. So if we get rid of these scribbles and we simply move back in time here, you would see that you could use this reach point as the purpose for the next trend in this chart. So let's just wait till we get a move, and it's right there. And you could then take the reach point of your original trend and create the base point for the next trend. And this would give you an accurate representation of architecture. And then just going forward, you could do the same thing and move it here. So this is the way trends work. They have an architecture that builds inside themselves. And if you were to break this smaller trend, its job would be to go and attack this next trend, which would then try to attack a larger trend, and so forth and so forth. So if we actually just hit play here, you can see what happens with this trend. It goes up to it, it breaks it, it tries to break through the next trend, and it doesn't have the ability to do so. So we would simply delete this trend, as this is kind of the grandfather trend, or what I like to call the legacy trend of the move. The legacy being the oldest trend in existence. The global trend would be the next one you create. So then you have a legacy trend and a global trend. And the local trend, for reasons of it's local to the move, it's the most local piece, I would call that the local trend. So then you have kind of a three-tiered architecture of trends and the way they work and the way they're created. You have a legacy trend that controls the entirety of something, like in this case, Bitcoin, or any chart that you're looking at. You have the global trend, which is the breaking point that needs to start trying to reverse the move. And then you have the local point, which is the local point that needs to start these attacks. So you have this architecture of 3 layers. So we can just go forward in this move, get to the current scape of the move, and there we are. Bitcoin's all caught up. So now what we can do is we can create a new architecture for this chart. We have the ability to go down in time frames. So let's do that. Let's go to a 4-hour chart here and see, hey, this is looking pretty great. This trend was actually pretty bang on. We can use this point here to create our next trend, which would have been like this, which then would be the global trend to this legacy trend, which would then have a localized trend to it. So we wouldn't adapt it to this one here for reasons of hard close, which we'll get into the future. But what we would do, and again, the important part of this lesson is that you understand how trends work and not so much the exact points that we need to go through them. Once we go through the hard close lesson, you'll understand completely how to work with trends, as we're going to come back and revisit trends on the hard close lesson. But for now, let's talk about the architecture that they create, why it creates it, and how we array this. So at this point, we would hard close it to this candle here. And the reason we're using this candle is because the bottom side of the wick closed it. Again, more on that in the future, but we would use the bottom side of the candle that closed it. So then we would adapt it to here, giving us our next trend to break, which you can see breaks right here, and then so forth and so forth. And this is the way trends work, is that you have points that break and array and continue to create new higher parts of their moves. So in the next lesson, we'll talk about cycles, which is exactly that, and how a move cycles through. But in this lesson, what we're doing again is creating that architecture so that we can understand cycles and hard closes in the future. So now we're going to go back to our original time frame because we never want to use trends and work up. And we're simply going to mark our next candle here, which is accumulation, to this candle right here. And that would be how you actively use a trend properly. Now, there would be other trends as well. So if you were to mark this trend out as, hey, this is controlling this part of the chart, there would be smaller trends underneath that that would have that kind of same 3-tiered structure. An example of that would be this right here, how you have an accumulation candle inside of what's called a range right here. So this would have its own interior architecture as well. In this move right now, well, it seems like it hasn't had enough time to break up and create this type of architecture. So kind of what may happen in the future here for Bitcoin is you may go and break this trend, maybe have a move up to somewhere like this, which is what we call a hold level. And then in the future, what you're going to do is this trend would then array from this point to here, and it would give you the means to create that architecture that you would need going forward, creating the next base and reach point to give you because remember, this top one would be the legacy trend, and this would give you the means to create your global trend, which would then have a local trend that's very localized in the move. We're not quite there yet on this chart. So what we're going to do instead is we're just going to rewind this back to here. We're going to get rid of this green box because this was just meant to show you a representation of the range. And instead, what we're going to do is we are going to go and we are going to start creating trend work a little lower in time frame. So as we just created that large, bigger bounding box of what could be higher up trends controlling larger parts of the chart, and that's really how you have to think of trends, is that where they start and the points that they exist, they control larger parts of your trend or your charts. So if I was to go all the way back here and I was to mark this to this as a trend, I would have a larger controlling piece of my chart that trend is controlling. So this would be controlling something like all the way down here to up here. And then if I were to go and create this next trend, which would be this distribution candle on the bottom side to this one here, well, you would see that it had the perfect, actually, almost to the dollar, the perfect respect of a move where it comes and it backtests that trend. And then it has a huge move up. Okay, so let's reduce some of this confusion on the screen here. Let's take off these trend lines. And you can see that if you went to this moment where that trend broke, well, you're going to have a pretty large reaction on the chart. So actually, the best way to do this is to use the replayer tool. We're going to go here. We're going to cut the time frame to right here. And we're just going to go to a very small time frame to see what happened in this moment. And you can see that by attaching distribution to distribution candle, we have impeccable accuracy as to where this thing tried to bounce. It wasn't able to. It failed that move. And like a hot knife through butter, this thing melted through within like 1 minute. As soon as it lost this trend, this thing fell off a cliff. So this is why we use distribution to distribution on the bottom side, as shown right here, and here distribution to distribution. So if we follow the chain of this architecture, you're going to see this would be the legacy trend in this move. So what we're going to do is we're going to go to text and we're going to mark this as legacy, just so everybody follows along. This one here would be your global trend because it's smaller or not as old. You could think of this as grandfather, father, child. So this would be the global or the father, and the legacy would be the grandfather or legacy, of course, and the local would be the child. So that would be another good way to think of it. And you can see that this would then have an architecture going forward as well by attaching this distribution candle to this distribution candle here, giving you the final breaks of the move. To find this one, though, you'd have to go down in time frames. So this is where it gets a bit tricky with the effect of time and the way day trading charts work. You can't ever stick with one time frame. And the rule is you can never move up in time frames as well. Everything in day trading falls under the theorem of recycling or decycling information. So things actually can't go up in time. They can only go down. So if you created something on a daily chart, you couldn't actually go up to a weekly chart and expect to find points that will have accurate data. Instead, you actually have to go down. So what we would do here is we would actually go down to find the best point that we can, distribution candle, that is the furthest inside of this trend. And then we would mark it to this distribution candle right here. And you would see that same impeccable accuracy as it falls through. Well, once it starts to adapt down, you could see that you could move the trend to here, distribution to distribution candle only. Never use the wicks that are just the lowest points. This is completely inaccurate. And you can see that we've marked distribution to distribution, and it's given you impeccable accuracy on this trend, so that when you actually lose this trend and you hard close it, which is this candle right here, the blue candle, this white one can't hard close it. This beige colored candle cannot hard close it. More in the future on that. But if you're in distribution, only a distribution candle can close your trend. If you're in accumulation, if you are on this top side here, like this, only an accumulation candle could break it. So if you were to go here, actually this white one here could break it. This blue one cannot, regardless of the bottom side of the candle falling through. And the bottom side of the candle would be considered the hard close. Again, more on that in the future. Don't worry about it for now. Worry about trend accuracy and we'll get there. So now if we go back to our original schema here about how we created architecture of this trade and this chart, you can see how you get pinpoint accurate results by following this logic trail of using distribution to distribution on the bottom side and never using accumulation wicks, only using the blue or red ones on the bottom and white or green on the top if you're using your default colors. And this would be local here. So that's how the actual architecture of trends works. The architecture works in a facet that you have 3 points and they go down in time frames and they go down. Remember, everything in day trading is decycling or recycling information. So larger information compresses down and down and down. And this is across all theories in day trading. Everything recycles itself. It's actually impossible for day trading sciences to go up in time frames because that would actually break into a different body of theorem completely. Everything decycles as things are existing first in the chart. They are older than the moments that exist here, therefore making them larger events that decycle down in time. And that's why we can only go down in time frames. So when we use the daily time frame and we move down to the 4-hour time frame, you can see where the accuracy is impeccable in this chart. And you get the perfect point where this breaks the first part of the move. The local trend is broken. Now, when a local trend breaks, it's going to go after a global trend. So a local trend breaks, you go after your global trend. Very straightforward. When a global trend breaks, it will try to go after the legacy. Hasn't quite reached that point yet. And now we are in a different moment in time. We have now moved our chart to here. Again, we'll go over that in the future and why we'd array that there. but you need to realize that your trend points array in your charts. And when you are arraying them and you are deciding to move the reach points, you only move the reach point to a blue candle on the bottom side. And I'm getting to be a bit of a broken record at this point, but only the blue on the bottom, only the white on top. So if we were to go and do this right here, we would mark this like this, and voila, we have perfect accuracy here. And then you could mark this down further from this point here to this, and then this would, if you were going to array this here, you could never use a blue candle. You could only use a white candle, which would be right here. And then if you were going to array it again, you would be right here. Now, we're going to go through one kind of advanced spoiler topic that's a little ahead of future of trading, but with the remastered version, that's the great thing. I can kind of put better parts of information in newer and updated series. There are ranges within ranges within ranges, which means that these larger charts out here, these larger controlling pieces out here, they are controlling this range like this. They have a very large part of the chart that they're actually trying to sustain, right? Let's get TradingView Snappy again, refresh it. If we actually were to go down into this chart and use a smaller range or a smaller controlling piece of the chart, well, you could get an accuracy that would give you the same type of result as to where you have this right here, where you're using an accumulation to an accumulation candle on a more interior part of the chart. So almost think of this as an interior piece inside of that global or localized portion. So if you had this architecture of this was a legacy level up here, and then you had a global level and a local level, well, realize that that localized level would have its own pieces inside of it as well, where that localized level would have its own architecture underneath it. So the local level may be local to the legacy level on the chart that's existing out here, but it would be the legacy level to the information underneath it. And what I mean by that is we can go and take a look. We're going to remark this trend back to right here, and we are going to go and use the same time frames that we did on our previous example here, from here to here. So this would be the local trend, and let's delete these so we only have the 3 on our chart, and let's make this local. Oops, let's make this local like that. This would then be legacy to the information inside of it. So while it may be local to the grander scheme of things, this would have a range inside of it that would be like this. Let's take the replayer tool. Let's cut it off right here. You have the reach point, which is right here, and then it would have its own interior time frames that it would have. So if you were to take this point here and mark it to here, you would see that this would now be the legacy move to this interior time frame that would then break down to right here and give you another type of accuracy in the chart. And if we hit play here, you can see where it loses that and it goes straight down. So in the case where this is a local trend that you've marked, well, this would be local on the grander scheme of things, but in the lower scope of things, this would actually be a legacy trend. So trends exist inside of trends, and then this would give you a global level right here. So you'd go distribution to distribution, and that would now be, this is legacy to this global, which would have an even more local part in its trend. And that's how you see the degradation of trends or the breaking of moves, is by looking at these ranges inside of ranges inside of ranges. So let's take the replayer tool off. Hopefully that's not too confusing for the first lesson in Future of Trading Remastered, but I think people can keep up with that. Let's delete this one as we no longer need it. It had broken its part of the move. And let's go back and look at now this example here. We're going to go to the 4-hour time frame, and where this may be a local trend somewhere else, this can actually control this small part of the range right here. So where this may be local because it is a very small piece of the overall charts, this would actually be legacy to this small range that exists right here, which would have smaller trends inside of smaller trends inside of smaller trends like this. So you take accumulation and you'd go to this accumulation. At that point, you could take this accumulation, and that would be the global part of the move. And you could take, well, you'd actually have to go down in timeframes here to see this. And you can see exactly where this breaks its chart out, right? And then you could take this one and move it to right here. You see how we created that hierarchy of local, global, and legacy. Local in the very closest part of the move, global on the second tier, and legacy as the final tier. And then you can see how these trends break and attack each other. This trend breaks and attacks this trend here. The local trend inside of this move right here, and this would be local, breaks and attacks the global trend, which would be this guy right here. Global. And that would have the legacy trend right here, controlling this part of the move. And one breaks to attack the other, to attack the other. Now, don't yell at me because this is distribution to the middle point on a lower time frame. I had gone through here and I saw, oh, hey, there's a white candle here attached to this white or beige, whatever color you want to call it. And that gives me an accurate reading. And then you would have this candle here, which is beige, that ties to this candle here, which would be even more localized. So you don't have to necessarily keep this as 3 points. It can go 4 points. It can go 5. Just realize you're creating further architectures of something that's localized, attacking a global component or a global controller that has the legacy part of the move that's kind of controlling the entirety of the range. And you can see how much trouble Bitcoin is having right now getting over top of this trend. It is trying its hardest to actually break this trend right now. And then you can find your accurate trend points and how they're created, how we array them, and how we actually work with trends. We could just for fun do this on the bottom side too if we wanted. We're going to use a little bit more of an advanced tactic here, but we're going to go here and we're going to tie this to the 5-minute point right here. Don't mind that it's a white candle. This is just a little more advanced to show you how I would use trends in this moment. And we're going to mark this one to here, which would give you your accuracy in the future part of this move on your higher time frame. So this is getting a little more advanced, or if you were using bigger time frames, you would have actually went to right. Nope, that's actually perfectly fine. You have the point right there. You have your point back here, which starts the controller of the move, and it's going to try to break that trend just like it's trying to break the trend on the top right now. And so if I were to use this architecture in a trade, what I would do is I would first delete this just to not confuse people, get a nice clear picture on our screen here. And then I would use my other time frames down to work with distribution points to other distribution points. And I would go time frame down. Remember, we can never go up in time frame. So we can go distribution candle here to distribution candle here, and you're going to have the accuracy as that breaks, and it then goes to this distribution candle here, which gives you the accuracy there, and it will give you a very good depiction or a very good reading of your charts. And as you move down through time frames, you're going to increase the accuracy of your trend. So this is something to keep in mind for the future. As we continue to work with trends, there's going to be a few new rules I introduce, but as you go down in time frames, you're increasing the accuracy of your trends, but you're reducing the strength of the trend. As it's a smaller time frame, it's not as strong, but it is more accurate because it is more finite and it's more recycled and more worked through. So if we moved it to here, we'd get a higher accuracy in our chart. Aha, you see, now you have an even higher accuracy in your chart. If you were to move down one more time frame, you could go and you could say, okay, well, it's right here. What if we pinned it to the next hard close candle, which would be up here? That would be up in this range here, which would be right here. You see, you're getting even more accurate results by continuously moving distribution candle to distribution candle, time frame down. It's just that what you're doing is you're weakening the trend. So if you notice a trend is constantly arraying out into smaller and smaller time frames, remember, we can never move up in time. If you notice your trend is constantly arraying down smaller and smaller time frames, realize it is getting weaker and weaker as it is recycling itself to a more finite point of breaking. So that's a good overview of trends and how we use them, how we array them, and how they're created. Really, the only point for this lesson and the most important thing that people get out of this is that we mark accumulation to accumulation candles on the top, distribution to distribution candles on the bottom side, and we only work down in time frames, as everything we'll ever do in day trading is one of the core principles, one of the founding pieces of the science in day trading. It always decycles information from oldest to youngest and from highest time frame down across both axes of time, horizontal and vertical, which is going to be our next lesson. And we're going to go deeper into that. And we're so important to know that we move time frame down, decycle information. We have trends that array further down into trends, the right points to mark them on your charts, and to never move up in time. Okay, we'll see you on the next lesson.